Now, to discuss more, we are being joined by Mitali Nikor. She is an economist and the founder of Nikor Associates. Thank you so much for joining us this morning. Let me just begin by asking you, what are the key factors behind India's unexpected 5.4% GDP growth in Q2?
So good morning, and thank you for featuring my views and the analysis that Nikor Associates keeps doing on India's macroeconomy and also on the overall global economic monitoring that we do. So when we look at, India's economy for the last quarter, what has been the real growth decelerator? Normally we say growth driver when we're decoding the numbers. So when I looked at it, essentially the manufacturing sector is the one that showed almost like a breakout star in 2023. But in 2024, that's where the massive slowdown has happened, because in 2023, we saw that for Q2, manufacturing sector actually grew by 14%. But this year, the manufacturing sector has fallen by almost 2 to 3, to a growth of just 2 to 3%. And that's been the main sort of decelerator. Apart from that, of course, private sector investment, the gross fixed capital formation, as we say, has slowed down. But there are green shoots, because the services sector, the agriculture sector, and private final capital expenditure, that is, basically consumption expenditure, that has gone back up, from what we saw, the levels we saw in Q2 2023. So essentially, a slowdown in manufacturing, a slowdown in private investment, also a slowdown in government spending these quarters are the main reasons why we are here today.
Right. Now, that being said, how do you think the Reserve Bank of India will approach its upcoming monetary policy announcement in December?
So if you recall, a couple of months ago when the Reserve Bank had the Monetary Policy Committee meeting, they went and they said that they're going to take what they call a neutral stance, sort of saying that, we need to look at where the trajectory that inflation is taking versus the trajectory that's being taken by growth and employment. And it's fairly evident that growth is, of course, slowing down. And one of the major reasons, as we've said, is this entire push towards investment. I mean, the economy, the government at this point in time, putting all its, focus on bringing manufacturing investment to India from all over the world. So I think the writing on the wall is clear. There has to be more of an action towards restarting that manufacturing cycle, restarting the investment cycle, and for that, interest rates have to be lower.
Right. Now, before I let you go, if you could just tell us about what implications does the lower than expected GDP growth have for India's long-term potential growth rate?
So I don't think that this is going to actually have that much of an impact on the long-term potential growth. I think this is a cyclical effect that we're seeing. We saw a lot of announcements in 2023. We saw a lot of investment coming in 2023. So we see a slight slowdown in this year, and it's not like we're not seeing growth. We still see some growth coming in. And also other industries, if manufacturing slows down, we see agriculture is recovering from 2.5 to 3.5% growth. We see services sector is recovering from a 6% back to around 9% growth in this very quarter. And also it's the quarter which was just post the elections, and that's when government spending was still restarting. So I don't think that this is significant from a long-term perspective. It's not signaling a long-term slowdown, but yes, it does signal that in the current cycle, the interest rates are starting to get too high for the private sector to come and invest. Whereas at the same time, inflation is now currently quite stable at around 4% and very much within the RBI limits. So therefore, I do think that now the conditions are quite ripe for the RBI to consider, a rate cut.
Right. All right. We'll have to leave it at that. Thank you so much, for joining us. Mitali Nikor, she is an economist and the founder of Nikor Associates. Thank you so much for joining us this morning and giving your insights.
Thank you.